Most people think they know how the Federal Reserve was created. Congress passed the Federal Reserve Act in December 1913. Woodrow Wilson signed it. A central bank was established to stabilize the American financial system after a series of devastating panics. Democratic process, public debate, legislative action. The standard story of how American institutions are built. But here is the problem with that version. It describes the last step of a process that had already been completed in secret 3 years earlier on a private island off the coast of Georgia by 7 men who arrived at the train station in New Jersey under false names, who told no one where they were going, and who spent 9 days designing the legislation that Congress would later debate and pass as though the debate were the origin of the idea. The meeting at Jekyll Island in November 1910 is not a conspiracy theory. It is documented in the memoirs of the men who attended it. The participants themselves wrote about it, after enough time had passed that the admission could no longer affect the legislation's fate. What they wrote is specific, detailed, and available to anyone who looks for it. The question the conventional account never asks is why men designing a piece of landmark financial legislation felt the need to do it in secret, under false names, on a private island owned by a club whose members included J.P. Morgan. The answer to that question is the real origin of the Federal Reserve. Start with the panic of 1907. In October of 1907, the American banking system came within hours of complete collapse. The trigger was the failure of the Knickerbocker Trust Company in New York, one of the largest trust companies in the country, which touched off a cascading series of bank runs that spread across the financial system with a speed that the regulatory apparatus of the period had no capacity to contain. The man who stopped the panic was not a government official. It was J.P. Morgan. Morgan, then 70 years old and the most powerful private banker in America, organized a series of emergency meetings at his private library on 36th Street in Manhattan. He summoned the presidents of the major New York banks, locked the doors, and refused to let them leave until they'd committed sufficient funds to stabilize the failing institutions. He personally directed which banks would be saved and which would be allowed to fail. He decided the terms on which emergency credit would be extended and the conditions that failing institutions would have to accept. The United States government in October 1907 had no mechanism for doing what Morgan did. The Treasury Secretary, George Cortelyou, deposited $25 million of federal funds in New York banks to provide liquidity, but the actual management of the crisis was conducted by a private citizen whose personal authority over the banking system was greater than the government's institutional authority. Morgan's management of the 1907 panic was understood by contemporaries as both heroic and alarming. Heroic because it worked, because the banking system stabilized and the broader economic damage was contained. Alarming because it demonstrated that the stability of the American financial system depended on the personal willingness and capacity of one man, and that when that man was gone, as he eventually would be, there would be nothing to replace him. The congressional response to the panic of 1907 was the Aldrich-Vreeland Act of 1908, which created the National Monetary Commission to study the American banking system and recommend reforms. Senator Nelson Aldrich of Rhode Island was appointed chairman of the commission. Aldrich was not a neutral figure. He was one of the most powerful Republicans in the Senate, closely connected to the financial interests of Wall Street, and his daughter was married to John D. Rockefeller Jr. His appointment to lead the commission that would design the reform of the American banking system was, from the perspective of the major New York banks, an ideal outcome. The National Monetary Commission spent 2 years studying European central banking systems, publishing reports, and conducting hearings. None of this produced a legislative proposal. The Commission's research was genuine, but the translation of that research into a specific legislative framework required something the public process could not easily provide: a room in which the men who actually ran the American financial system could design the institution they wanted without the interference of political considerations that might distort the result. That room was on Jekyll Island. Jekyll Island in 1910 was accessible only by private boat. It was owned by the Jekyll Island Club, a private organization whose members included Morgan, William Rockefeller, and other figures from the apex of American finance. In November 1910, a group of men assembled at a train station in New Jersey under instructions to use first names only and to avoid being seen together in public. The participants, as they subsequently identified themselves in their own accounts, were Nelson Aldrich, the Republican Senate leader who chaired the National Monetary Commission, Frank Vanderlip, president of the National City Bank of New York, which was the Rockefeller family's primary banking institution, Henry Davison, a senior partner at J.P. Morgan and Company, Charles Norton, president of the First National Bank of New York, Arthur Shelton, Aldrich's personal secretary, A. Piet Andrew, assistant secretary of the Treasury, and Paul Warburg, a partner at the investment bank Kuhn, Loeb and Company, and the most technically sophisticated banking expert in the group. Paul Warburg had emigrated from Germany in 1902. His family had been in banking for generations, and he had a deep familiarity with the European central banking model, particularly the German Reichsbank, that the American system lacked. He had been advocating for an American central bank for years before Jekyll Island, publishing articles in financial journals that laid out the technical case for a central banking institution. Warburg was, in a meaningful sense, the intellectual architect of what was designed at Jekyll Island. He knew what he wanted to build and had the technical expertise to design it. Aldrich provided the political access. Vanderlip and Davison provided the institutional weight of the major New York banks. The 9 days on the island produced a draft legislation that would, with modifications designed to make it politically palatable, become the Federal Reserve Act. Frank Vanderlip described the Jekyll Island meeting in an article published in the Saturday Evening Post in 1935, 25 years after the meeting occurred. His account is specific and detailed. He wrote that the secrecy was essential because if it became known that the major New York bankers had drafted the legislation, Congress would have rejected it on the grounds that it was designed to serve banking interests rather than the public interest. Vanderlip's own words, in a nationally published magazine, 25 years after the fact. The secrecy was not incidental to the process, it was the process. The legislation was designed by the people who would benefit from it, in secret, and then presented to the political system as the product of a neutral expert commission. The political debate that followed was genuine in its procedural form and constrained in its substantive scope by the fact that the technical framework had already been designed by people whose interests in the outcome were not disclosed to the legislators debating it. Nelson Aldrich presented the results of Jekyll Island as the Aldrich Plan in 1911. The plan was immediately attacked by Democratic politicians and progressive reformers who recognized it as a device for centralizing financial power in the hands of the Wall Street banks. The critique was accurate. The Aldrich Plan would have created a central bank controlled primarily by the private banking system, with minimal government oversight. The political opposition to the Aldrich Plan was strong enough to prevent its passage. But the technical framework designed at Jekyll Island did not disappear with the Aldrich Plan's failure. It was preserved and modified by a different group of men operating in a different political context. The 1912 election brought Woodrow Wilson to the presidency and gave the Democrats control of Congress. Wilson had campaigned against the money trust, the concentration of financial power in the hands of a small number of New York banks, and his election created a political environment in which openly banking-friendly legislation was not viable. The task of transforming the Jekyll Island framework into legislation that could pass a Democratic Congress fell primarily to Carter Glass of Virginia, chairman of the House Banking Committee, and his advisor H. Parker Willis. Glass and Willis were not members of the Jekyll Island group. They were genuine reformers who believed that the banking system needed restructuring. But the technical problems they were trying to solve, the lack of a lender of last resort, the inelasticity of the currency, the absence of a mechanism for managing the relationship between the domestic money supply and international gold flows, were the same problems that Warburg had identified and designed solutions to at Jekyll Island. The technical solutions Glass and Willis arrived at were, in their essential structure, substantially similar to the solutions designed at Jekyll Island, because the problems were the same and the technically viable solutions to those problems were limited. Paul Warburg participated in the legislative process that produced the Federal Reserve Act, serving as an advisor and technical consultant to the banking committees of both houses. He was one of the 5 original members of the Federal Reserve Board when it was established in 1914. The man who had drafted the original framework at Jekyll Island in 1910 sat on the governing board of the institution that framework became in 1913. The conventional account of the Federal Reserve's creation presents Jekyll Island as a footnote, an interesting historical curiosity that preceded the real legislative process. The revisionist account associated primarily with G. Edward Griffin's 1994 book The Creature from Jekyll Island presents Jekyll Island as evidence that the Federal Reserve was designed from the beginning to serve banking interests at the expense of the public. Both accounts are, in different ways, incomplete. The Jekyll Island meeting was not a footnote. It was the moment when the technical framework of American central banking was designed by the men who would benefit from it, in a setting specifically chosen to prevent public scrutiny. That is documented by the participants themselves, but Griffin's account, which has been enormously influential in skeptical circles, overstates the conspiratorial coherence of what was designed. The men at Jekyll Island disagreed with each other on significant points. Warburg and Aldrich had different visions of how the central bank should be structured. The legislation that eventually passed differed from the Aldrich plan in ways that reflected genuine political compromises, rather than a seamless translation of banking interest into law. The Federal Reserve as it exists is neither the neutral public institution that the conventional account presents, nor the perfectly designed banking cartel that the conspiratorial account describes. It is something more complicated. An institution whose technical framework was designed in private, by men with significant interest in the outcome, modified through a political process that introduced genuine public interest considerations, and operated in the century since its creation in ways that have reflected both the banking interests that shaped its design and the public interest considerations that the political process imposed on it. Understanding which of those two influences has dominated in any given period requires examining the Fed's actual conduct rather than its origin story. But the origin story matters because it establishes what the institution was designed to do before the political process modified it, and because the design constraints established at Jekyll Island have been more durable than the political modifications imposed on them. The Federal Reserve's structure, specifically the combination of regional Federal Reserve banks owned by private member banks and a Federal Reserve Board appointed by the President, reflects the compromise between the banking interest in private control and the political interest in public accountability. That compromise has never been fully stable, because the private ownership of the regional banks and the board's appointment process create incentives that pull in different directions. The tension was visible almost immediately after the Fed's creation. The Federal Reserve's conduct during the 1920s, specifically its management of credit conditions that contributed to the speculative bubble that preceded the 1929 crash, reflected decisions made by men whose institutional and personal interests were intertwined with the financial markets they were supposed to be managing. Milton Friedman and Anna Schwartz, in their 1963 Monetary History of the United States, argued that the Federal Reserve's conduct between 1929 and 1933 turned a severe recession into the Great Depression by allowing the money supply to contract by a third. Their analysis, which is the most influential single work in the economics of the Depression, attributes the Depression's severity not to capitalism's inherent instability, but to the Federal Reserve's policy failure. The Federal Reserve, the institution created to prevent the kind of banking panic that had occurred in 1907, presided over the most catastrophic banking collapse in American history 20 years after its creation. Whether this reflects a design failure, a leadership failure, or simply the inherent difficulty of managing a complex financial system in unprecedented circumstances is a question that economists have debated for 90 years without reaching consensus. What is not in dispute is that the men who designed the institution at Jekyll Island intended it to prevent exactly the kind of crisis that occurred between 1929 and 1933, and that it failed to do so. The Jekyll Island meeting is documented. The participants documented it themselves. The question of what it means, of whether the secrecy and the private banking interests that designed the Fed's framework have shaped its century of operation in ways that the public has not fully understood, is a question that the institution's own conduct over that century is the primary evidence for. That conduct has been extensively analysed by economists, historians, and critics across the political spectrum, and the analyses do not point in a single direction. The Fed has at various times been accused of being too close to Wall Street, too focused on inflation at the expense of employment, too willing to bail out financial institutions whose failures should have been allowed to discipline the system, and too slow to recognise the asset bubbles that its own policies helped create. These are not fringe criticisms. They come from Nobel Prize-winning economists, from former Fed officials, and from the congressional oversight process that has been examining the Fed's conduct since its creation, the Jekyll Island origin is the beginning of that story, not the end of it. The 7 men who gathered in November 1910 under false names on a private island off the coast of Georgia designed the framework of an institution that has shaped American economic life for over a century. They designed it in secret because they knew that if the public understood who was designing it and why, the design would be rejected. Frank Vanderlip said so himself in 1935 in the Saturday Evening Post. The institution they designed is still operating. Its technical framework, modified but recognizable, is still in place. The debate about whether that framework serves the public interest or the interests of the financial system it was designed by is still active. The documents are in the archives, the memoirs are in print. The congressional record shows Aldrich's false names on the passenger list. The origin is documented. What you do with that documentation is the question the conventional account has preferred not to ask. If you want to follow the documents rather than the official version, subscribe. We go where the record leads. I'll see you in the next one. But to understand what was actually designed at Jekyll Island, and why the secrecy mattered beyond simply avoiding political opposition, you have to understand what the American banking system looked like before 1913 and what specific problems the men on the island were trying to solve. The United States in 1910 was the largest economy in the world and the only major industrial nation without a central bank. Every European power, Britain, Germany, France, had a central bank that served as a lender of last resort, managed the currency, and coordinated the national banking system in times of stress. America had a network of thousands of independent national and state banks, coordinated by nothing except the market, connected by correspondent relationships that transmitted financial stress across the system with extraordinary speed, but provided no mechanism for containing it. The result was a financial system that was, by the standards of the period, uniquely unstable. The United States had experienced major banking panics in 1873, 1884, 1893, and 1907, a frequency of crisis that had no parallel among the major economies. The panics were not random events. They reflected structural features of the American banking system that made it vulnerable to the kind of cascade failure that the 1907 panic had so dramatically illustrated. The most important of those structural features was the inelasticity of the currency. The supply of national banknotes, the primary form of paper currency in circulation, was tied to the quantity of government bonds that banks held as reserves. When credit demand expanded during the harvest season, or during periods of business expansion, the money supply could not expand with it, because banks could not issue more notes without acquiring more government bonds, which were in limited supply and expensive. This created predictable seasonal credit crunches that made the American financial system vulnerable to the kind of confidence crisis that could trigger a panic. The European central banks, through their capacity to issue currency against commercial paper as well as government bonds, could expand the money supply elastically in response to legitimate credit demand. The American system could not. Warburg had identified this problem precisely in his pre-Jekyll Island writings. His solution, derived from the German model, was an institution that could issue currency against commercial paper, that could serve as a lender of last resort to banks facing liquidity crises, and that could coordinate the national banking system's response to both domestic credit conditions and international gold flows. The problem was not the diagnosis. The diagnosis was correct, and the technical solution Warburg had developed was sound. The problem was the governance structure of the institution that would implement the solution. In Germany, the Reichsbank was a public institution under government control. In Britain, the Bank of England was a private institution that had developed, over 2 centuries, a tradition of operating in the public interest that made its private ownership largely irrelevant to its public function. In neither case was the central bank designed by the private banking system it was supposed to regulate. At Jekyll Island, the central bank was being designed by the private banking system it would regulate. This is the fact that the secrecy was designed to conceal, not the technical details of the proposal, which were genuinely complex and genuinely important. The identity and interests of the designers. The specific design choices made at Jekyll Island reflected the interests of the designing institutions in ways that are visible in the document but that the conventional account does not highlight. The proposal called for a National Reserve Association, a central institution owned by and controlled by the member banks, with a board dominated by banking representatives and only minimal government representation. The currency issued by the association would be backed by commercial paper, as Warburg had proposed, but the discount rate at which the association would lend to member banks would be set by the association's board, which meant it would be set by the banks themselves. This structure gave the private banking system control over the price of credit in the American economy. The cost of borrowing for every business and every individual would ultimately be shaped by decisions made by an institution, controlled by the men who stood to profit from those decisions. The Aldrich Plan's defeat in 1912 was largely attributable to the recognition, by democratic politicians and progressive reformers, that this governance structure was precisely what it appeared to be. Carter Glass, in designing the Federal Reserve Act, modified the governance structure to include a Federal Reserve Board appointed by the President and confirmed by the Senate, with the private bank-owned regional Federal Reserve banks subordinate to that board. Whether this modification was sufficient to change the fundamental character of the institution is the question that has been debated ever since. The critics have argued that the board's members, despite their public appointment, have consistently come from backgrounds in finance and have shared the perspectives of the institutions they nominally regulate. The defenders have argued that the board's public accountability, however imperfect, represents a genuine constraint on the banking system's capacity to use the Fed purely for its own benefit. The empirical record of the Fed's first century provides evidence for both positions, which is why the debate has never resolved. What is not empirically contested is the Jekyll Island origin itself, or the secrecy that surrounded it, or the identity and interests of the men who participated in it. Nelson Aldrich died in 1915 before he could publish a detailed memoir. But his papers, held at the Library of Congress, contain his own notes on the Jekyll Island meeting and his correspondence with the other participants in the years that followed. Henry Davison, the Morgan partner, died in 1922 and left no published memoir of Jekyll Island. But his role is documented in the accounts of the other participants and in the Morgan firm's internal records, portions of which have been made available to researchers. A. Piatt Andrew, the Treasury official, kept a diary throughout the period of his government service. The diary's entries for November 1910 document the Jekyll Island meeting from the perspective of a participant who was simultaneously an official of the government that would later be presented with the legislation as though it were the product of a neutral expert commission. Andrew's diary is in the Dartmouth College archives. The documentation of the Jekyll Island meeting is not in one source. It is in the memoirs, diaries and papers of the men who attended, distributed across several archives and published in several sources over the decades following the meeting. The distribution of the documentation is itself significant. There was no single comprehensive account published because no single participant wanted to be the one to fully illuminate what had happened. The picture emerges from the accumulation of partial accounts, each one confirming the others. Vanderlip's 1935 Saturday Evening Post article is the most direct and comprehensive published account. His motivation for publishing it 25 years after the fact, when the institution was established and the political damage his disclosure could cause was minimal, is consistent with the pattern that characterizes the rest of the documentation. The men at Jekyll Island were not stupid. They understood that what they were doing, designing public legislation in private for private benefit, was politically problematic. They managed that problem by keeping the secret until the legislation had been passed, the institution had been created, and enough time had elapsed that disclosure was more an interesting historical footnote than a political threat. The timing of the disclosures, Vanderlip in 1935, others in subsequent decades, reflects this calculation. The institution was established. The secrecy had served its purpose. The truth could be acknowledged without consequence. This pattern of deferred disclosure is not unique to the Federal Reserve. It is characteristic of how consequential policy decisions are made in democratic systems, when the people making the decisions understand that the process, if conducted transparently, would not produce the outcome they believe is correct and necessary. The men at Jekyll Island believed with varying degrees of sincerity that a central bank was necessary for the stability of the American financial system. They were right about that. The technical solution they designed was in its essentials sound. The institutional structure they initially proposed, which the political process modified, was designed to serve their interests as well as the public interest. They understood that a transparent process, given the public suspicion of Wall Street in 1910, would not produce the institution they wanted, and they managed that problem by designing the institution in private. The Federal Reserve that resulted is a hybrid, technically sound in its essential design, institutionally complex in its governance, and consistently contested in its operation. It has prevented some panics, failed to prevent others, contributed to some crises through its own policy errors, and stabilized the financial system in ways that the pre-1913 system could not have managed. Whether that record represents a net benefit to the American public depends on what counterfactual you compare it to, and the counterfactual is not available. The alternative to the Federal Reserve is not observable. What is observable is what the Federal Reserve has done in the century since Jekyll Island, and that record is complex enough to support the range of assessments that economists and historians have offered. The origin story, the 7 men under false names on a private island in November 1910, is not the whole story. But it is the beginning of the story, and it tells you something important about the kind of institution that was designed, by whom, and for what purposes. The Saturday Evening Post article is from 1935. The congressional record shows the false names. The Dartmouth archives hold Andrew's diary. The Library of Congress holds Aldrich's papers. The documents are there. The Jekyll Island meeting happened the way its participants described it. What came out of it has been managing American monetary policy for over a century. Whether that arrangement serves the public interest is the question that the institution's own century of conduct is the evidence for. That evidence is in the public record. Read it. The real origin of the Federal Reserve is documented. Not in the congressional debate of 1913, in the papers of the men who gathered on an island in November 1910 and designed what the debate would eventually pass. That is where the story begins. Everything else followed from there. If you want to follow the documents rather than the official version, subscribe. We go where the record leads. I'll see you in the next one. The century of Federal Reserve operation since Jekyll Island provides the empirical test of what the institution was actually designed to do, and that test is more complex than either the conventional defenders or the harshest critics have acknowledged. The Federal Reserve's conduct in the 1920s is where the test begins in earnest. The Fed's first decade, from 1914 to 1923, was dominated by the management of wartime financing and the post-war adjustment. Its conduct was constrained by Treasury priorities and by the political conditions of the period in ways that limited its independent action. The 1920s were the first decade in which the Federal Reserve operated with substantial independence, and its conduct in that decade was shaped significantly by Benjamin Strong, the president of the Federal Reserve Bank of New York from its founding until his death in 1928. Strong was Morgan's man. He had been a Morgan partner before taking the New York Fed position, and his management of the New York Fed reflected the perspective and the interests of the major New York banks that the regional Fed was ostensibly supposed to regulate. Strong's management of credit conditions in the 1920s, specifically his decisions about the discount rate, contributed to the credit expansion that fueled the speculative bubble in stocks and real estate that collapsed in 1929. The relationship between Fed policy and the bubble is documented in the Federal Open Market Committee records and has been analysed extensively by economists including Milton Friedman, Anna Schwartz and Charles Kindleberger. Strong died in October 1928, 13 months before the crash. The Fed that faced the Depression was led by men who did not have Strong's authority or his relationships, and whose policy responses, documented in the FOMC records, reflected a combination of institutional confusion, competing regional interests within the Fed system, and adherence to the gold standard that constrained the policy options available. The Federal Reserve's failure to prevent the banking collapses of 1930, 1931, and 1932, which Friedman and Schwartz documented in their 1963 Monetary History, is the most consequential failure in the institution's history. The institution that was designed to prevent the kind of banking cascade that had occurred in 1907 presided over a banking collapse 20 years later that was orders of magnitude more severe than anything the pre-Fed system had produced. This failure is not in dispute. What is disputed is its cause. The Friedman-Schwartz argument is that it reflected policy errors that a better-led Fed could have avoided. The alternative argument, made by economists including Barry Eichengreen and Ben Bernanke, in his pre-Fed chair academic work, is that the gold standard constraint made the necessary policy response impossible regardless of who was making the decisions. Bernanke's analysis of the Depression's causes, developed in a series of academic papers in the 1980s and 1990s, concluded that the Federal Reserve's failure to act as a lender of last resort during the bank collapses of the early 1930s was the primary mechanism through which the Depression spread from a severe recession to a catastrophic economic collapse. His analysis also concluded that the gold standard constraint was a significant factor in limiting the Fed's response options. When Bernanke became Federal Reserve Chairman in 2006, his academic understanding of Depression-era policy failure shaped his response to the 2008 financial crisis. His decision to expand the Fed's balance sheet dramatically, to provide emergency liquidity to financial institutions that were facing the kind of cascade failure that the 1930s Fed had failed to prevent, reflected a direct application of the lessons he had drawn from the Depression analysis. Whether Bernanke's response to 2008 was the right response is a question that economists continue to debate. What is not debated is that it reflected a specific historical interpretation of the Federal Reserve's greatest failure, applied in real time to a crisis that had structural similarities to the one that failure had produced. The men at Jekyll Island designed an institution to prevent the kind of panic that had occurred in 1907. The institution they designed failed to prevent a much worse panic in 1930 to 1933. The analysis of that failure produced an academic framework that shaped the policy response to the next comparable crisis in 2008. The 2008 response prevented a repeat of the 1930s collapse, at least in its most severe form, but produced its own controversies about who benefited from the emergency interventions and who bore the costs. This chain of consequences, from the 1907 panic to Jekyll Island to the Federal Reserve Act to the Depression failure to the 2008 response, is the empirical record of what the institution designed in November 1910 has actually done in the century since. It is not a simple record of either success or failure. It is a record of an institution operating under the constraints of its design, modified by political processes and historical circumstances, making decisions that have had enormous consequences for the American and global economies. The design constraints that Jekyll Island established, specifically the combination of private bank ownership, of the regional feds and presidential appointment of the board, have shaped every major decision in that century of operation. The tension between the private banking interests represented by the regional bank presidents and the public interest represented by the board has been a constant feature of Fed governance, visible in the policy debates and sometimes in the public disagreements between regional bank presidents and board members. That tension was designed into the institution at Jekyll Island, not as a bug but as a feature. The men who designed it understood that a purely private central bank, as the Aldrich Plan proposed, was not politically viable. They designed a hybrid that preserved private banking control over the institution's regional operations while providing enough public accountability to make the legislation passable. The hybrid has survived for over a century. Its survival reflects both the genuine technical soundness of the central banking framework and the institutional interests that have made the existing structure difficult to reform. The Glass-Steagall Act of 1933, which separated commercial banking from investment banking and represented the most significant reform of the banking system since the Federal Reserve Act, was passed in the aftermath of the Depression. Its passage over the banking industry's opposition demonstrated that the Fed's design, whatever its private banking influences, did not make banking reform impossible. The repeal of Glass-Steagall in 1999, 73 years after its passage and 10 years before the financial crisis that its proponents argued it would have prevented, demonstrated that the banking industry's influence over the regulatory and legislative process was sufficient to reverse protections that the Depression had made politically necessary. The 1999 repeal was not a Federal Reserve decision. It was a congressional and executive branch decision. But the Federal Reserve under Alan Greenspan supported the financial deregulation that the repeal represented, and Greenspan's position reflected his genuine belief in the self-correcting capacity of financial markets that his subsequent congressional testimony acknowledged had been mistaken. Greenspan's 2008 congressional testimony, in which he described his discovery that banks would not in fact manage their own risk adequately, even when their own capital was at stake, is one of the more extraordinary documents in the history of American economic policy. The man who had led the Federal Reserve for 19 years, from 1987 to 2006, acknowledged before Congress that the philosophical framework underlying his conduct of monetary policy had contained a flaw. The flaw he acknowledged was the assumption, built into the Jekyll Island design in the form of private bank ownership of the regional feds, that private banking institutions would manage their own risk adequately when given the freedom to do so. The assumption was wrong. The 2008 financial crisis demonstrated that banking institutions, when given both the freedom to take risks and the expectation that the Federal Reserve would prevent their failure from cascading through the system, would take risks that the system could not sustain. The Jekyll Island men understood the banking system's tendency toward instability and designed an institution to manage it. They did not fully account for the moral hazard their design created, the possibility that the existence of a lender of last resort would encourage the very risk-taking that the lender of last resort existed to contain. This is not a criticism that the men at Jekyll Island could have anticipated in 1910. The theory of moral hazard in financial systems was not well developed in 1910. But it is a criticism that the Fed's century of operation has validated and that the 2008 crisis made impossible to ignore. The real origin of the Federal Reserve is Jekyll Island in November 1910. The real meaning of that origin is not that the Fed is a conspiracy against the public interest. It is that an institution designed in private by men with significant interests in the outcome carries within its design the imprint of those interests, and that imprint, visible in the governance structure and in the policy choices the governance structure enables, has shaped the institution's conduct through every decade of its operation. Frank Vanderlip said the secrecy was necessary, because if the public had known who designed the institution, it would have been rejected. He was probably right. The institution was designed in secret. It was passed through a political process that modified it. It has operated for over a century in ways that reflect both the design and the modifications. The documents are in the archives. They have been there since the beginning. The story they tell is more complex than either the conventional account or the conspiratorial alternative acknowledges. It is also more important. Because the institution that 7 men designed on a private island in November 1910 has managed American monetary policy for over a century, and its decisions have shaped the economic circumstances of every American alive since 1913. That is what the origin actually means, not a conspiracy, a design, made by specific people with specific interests in a specific context for specific reasons, documented by the people who made it, available to anyone who looks for the documents. The real origin of the Federal Reserve is not in the congressional debate of December 1913. It is in the papers of the men who gathered on Jekyll Island a month before Thanksgiving in 1910. That is where the story begins. Subscribe if you want to follow more of these stories where the documents lead. I'll see you in the next one. There is one final dimension of the Jekyll Island story that the conventional account has never addressed directly, and it concerns the question of what the men who gathered there actually accomplished relative to what they intended. The Aldrich Plan, the direct legislative product of Jekyll Island, was defeated. The Federal Reserve Act that passed in 1913 differed from the Aldrich Plan in significant ways. The Jekyll Island participants did not get exactly what they designed, but they got something. They got a central bank. They got a currency that could expand elastically in response to credit demand. They got a lender of last resort that would prevent the kind of acute panic that had terrified the financial system in 1907. They got an institution whose governance, while more publicly accountable than the Aldrich Plan had specified, still gave the private banking system substantial influence over monetary policy through the regional Federal Reserve banks and through the cultural and professional networks that connected Fed leadership to Wall Street. The distance between what the Jekyll Island men designed and what was ultimately enacted is the measure of the political process's modification of their design. That modification was real. Carter Glass was a genuine reformer who believed in public accountability and who structured the Federal Reserve Board specifically to provide it. The political compromise produced an institution meaningfully different from what Aldrich had proposed. Whether that difference was sufficient to change the institution's fundamental character, or whether the private banking influences preserved in the final design have been decisive in shaping the Fed's conduct across its century of operation, is the question that the empirical record of that operation is the primary evidence for. Reasonable people, examining the same record, have reached different conclusions. That is what a genuinely contested historical and policy question looks like. The Jekyll Island origin is a documented fact. What that origin means for the institution's subsequent operation is a question the origin alone cannot answer. What the origin does establish is that the public was not the author of the institution that manages its monetary system. 7 men, meeting in secret on a private island in November 1910, designed the framework. The political process modified it. The institution that resulted has operated under that modified framework for over a century. The Saturday Evening Post article is from 1935. Frank Vanderlip wrote it. He was there. He described what happened. He explained why it was done in secret. The documents confirm his account. The rest is in the century of operation that followed. Read that record too. Both parts of the story are there. Both parts matter. That is the real origin of the Federal Reserve. The Federal Reserve's centennial, marked in 2013, produced a wave of official commemoration and a parallel wave of criticism from across the political spectrum. Ron Paul, the Libertarian congressman who had been calling for an audit of the Fed for decades, published End the Fed in 2009. Bernie Sanders, the Democratic Socialist senator, introduced legislation requiring a Fed audit in 2010. Both men, from opposite ends of the political spectrum, were arguing that the institution lacked sufficient public accountability. The Federal Reserve Transparency Act, which would have required a comprehensive Government Accountability Office audit of the Fed's monetary policy decisions, passed the House of Representatives in 2012 with bipartisan support. It did not pass the Senate.